Hi everybody, this is Alan Ellman, the Blue Collar Investor, and welcome to this BCI podcast number 28. This one is titled In the Money Covered Calls, Intrinsic Value Protects Time Value, using strike selection to establish more defensive positions. Now, for covered call writing and selling puts, most option strategies, one size does not fit all. Most covered call writers tend to write out of the money strike prices higher than current market value, which is really what we should be using in the majority of the cases, since the market does tend to go up 8 to 10% a year historically. However, there are times when the market is more volatile, more bearish, and it's been going down, and we need that additional protection. And that additional protection could be garnered in several ways. One way is by strike price selection, the second of the three required skills. First is stock selection, second is option selection, and third is position management. In this podcast, we're going to hone in on in-the-money strikes and how they can help us in bear and volatile market environments. So let's break down the premium components of call options. Now, there are two components to our option premium. One is known as intrinsic value, and the other is time value. Now, intrinsic value applies only to in-the-money strikes because it's the amount that the strike price is lower than current market value. Only in-the-money strikes are below current market value. Now, time value is everything above intrinsic value. So that at the money strikes, an example would be buy a stock at 30 and sell the 30 call. Or out of the money strikes, example would be buy a stock at 28 and sell the 30 call. Those types of strike prices are all time value. There's no intrinsic value component to them. They are not in the money. They're not lower than current market value. So the formula for the time value of an in-the-money strike would be the total premium minus the intrinsic value. And that would be your time value component. So if a stock is trading at 32 and we sell the $30 call option for $3, we cannot count that entire $3 as profit because there's an intrinsic value component to it. How far is that 30 strike below the current market value of 32? Well, the answer is $2. So we must deduct the $2 from the $3 to give us our time value profit. If we counted the entire $3 as profit, it would be grossly exaggerating the situation. So in this particular scenario, $2 is intrinsic value. The 30 strike is $2 less than current market value, and our actual time value initial profit is $1. Therefore, if we divided $1 by 30, that comes out to a 1 month return of 3.3% because I favor 1 month options. Now, the downside protection of that 3.3% is $2, the intrinsic value divided by 32, and that comes out to 6.3%. So what that means is we are guaranteed a 1 month return of 3.3% as long as share value does not decline by more than 6.3% by expiration Friday, or stated differently, does not drop from 32 to below 30. Now here's a real-life example with Altassian Corp, which trades on the NASDAQ exchange under the ticker symbol TEAM. At the time that I was making this video, the price of the security was $84.48. Now, we selected the $80 in-the-money strike, lower than current market value, which generated a premium of $7.65. Once again, we can't count that $7.65 as all profit because we're going to be losing $4.48 on the sale of the stock, currently trading at $84.48, and we're agreeing to sell the shares for $80. So from that $7.65, we must deduct the $4.48 of intrinsic value, and that will leave us a time value profit of $3.17. Now, let's feed that into the multiple tab of the Ellman Calculator. Now, for those of you who have the Ellman Calculator, that would be the blue cells on the left side of the spreadsheet. So you enter the stock price at 84.48, the option premium of 765, the strike of 80, and what the calculator will show on the right side of the spreadsheet is that the time value return, the return on our option or root, is 4.0%. Now that's with the intrinsic value of 448 being deducted from the total premium of 765. So that's a real initial time value profit. Now upside potential, how much more can we make if the price of the stock goes higher? And the answer is 0. Because initially when we enter the trade, we're agreeing to sell our shares at a lower price than they're currently trading for. So it doesn't matter how high the stock price goes, we must sell at the agreed upon strike price. Now here's the important part. The downside protection of that time value profit is 5.3%. So in this particular case, we are guaranteed a 1-month return of 4.0% as long as share value does not decline by more than 5.3% by expiration, or stated differently, does not move from 84.48 to below the $80 strike price. So let's give the pros and cons of in-the-money strikes. On the positive side, the initial time value profit does have protection from current market value down to the strike price. So the intrinsic value protects the time value. Now, an in-the-money strike will also lower the break-even more than at-the-money and out-of-the-money strikes, because only in-the-money strikes have the additional intrinsic value component to them. Now, these are very, very good for bear and volatile market conditions. It gives us that extra protection to the downside. And it represents the most conservative approach to covered call writing. So if that aligns with your personal risk tolerance, then in-the-money strikes are right for you, maybe even all the time. I usually use these in bear and volatile markets and favor out-of-the-money strikes in normal to bull market environments. Sometimes I will use a combination. Now, on the negative side for in-the-money strikes, we do not participate in any share appreciation because of our contract obligation. Also, exercise is more likely because we're starting out with in-the-money strikes. Now, we could always buy back that option to avoid exercise, but generally speaking, that is considered one of the disadvantages. Now, there's only one possible income stream within the money strikes, the premium. Whereas with out-of-the-money strikes, we have an opportunity for second income stream from share appreciation from current market value up to the strike price. And in-the-money strikes are not the best choice in bull market conditions. So just to summarize now, strike price selection is the second of the 3 required skills in order to maximize our option selling returns. In-the-money strikes are best for bear and volatile markets, and it lowers our risk in really all market conditions. And if we could summarize this video in one sentence, its intrinsic value protects time value. For more information on covered call writing, the 3 required skills, and strike price selection, visit our store, thebluecollarinvestor.com/store, where we have a whole series of books, DVDs, calculators, and much more to help elevate our returns to the highest possible levels. We also have premium member benefits, which consists of multiple reports we provide to our members on weekly and monthly basis, expanded calculators, about 200 educational videos, and many, many more files that will also assist in elevating our returns to the highest possible levels. I want to thank everybody out there for taking the time to listen to this podcast. I hope you enjoyed it, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.